there, folks. It is official. Jamie Dimon is starting to flip on the economy and his overall feelings on the economy and kind of what he is seeing out there. And so I want to play two clips in this video. The first one we're going to watch, essentially, this is from a little over 3 months ago. And I think it's important to watch this together because you're going to hear his tonality, how he was feeling about the markets and those sorts of things is very, very positive. And then we're going to watch this latest one here, essentially, and you're going to notice very much a shift where he's talking about significant risks now for the economy. And this is all transpired in literally about, a little over a 3-month span, essentially. And that's how quickly it can happen in the economy, where you can go from, seeing a lot of positive things to seeing potentially negative things. On the flip side, from seeing negative things to positive things, it happens pretty darn quickly. It doesn't take necessarily 2 years for something like this to happen. Over a 3, 4, 5 month span, you can, definitely see different things. And when it comes to JP Morgan's CEO, right? When it comes to somebody like Jamie Dimon, he sees everything. This guy is involved with everybody. He knows everybody. He can see business activity coming in. He understands how all this stuff works. And so if he sees some troubling things, he's going to tell us kind of what he sees out there troubling. So I think this is definitely worth paying attention to and kind of hearing what he has to say here and kind of figuring out, do we have something coming? Is there some bad stuff coming, or are we going to be okay in all this? So I hope you guys enjoy this as always. Also, make sure you check out first a link in the description down there to sign up for FTX. Use my referral code Holy Smokas, and right now they actually got a deal where essentially for every, I think it's $100 you deposit with FTX US, you actually get $10 of crypto free. So that's pretty darn awesome. Alrighty, guys, let's jump into this.
Street stocks selling off yesterday as investors reprice equities ahead of the Fed's transition from easy money policies to tightening policies. There's also, of course, questions about the impact of Omicron and inflation on earnings. I interviewed JP Morgan Chairman and CEO Jamie Dimon in the middle of all the volatility yesterday and got his views on the backdrop and what's ahead for the year.
I think the way to really look at it is first to look at the economy and then the markets. The economy, the consumer's in great shape. Obviously, there's some folks still suffering out there, but they've got a lot of money. They're spending 25% more than they did pre-COVID. Their balance sheet's in great shape. The debt service ratio is better than it's been in 50 years, literally. Home prices are up. Stock prices are up. Businesses equally are doing quite well. They got plenty of money and plenty of confidence. So that economy is growing. The numbers are herky-jerky because coming out of the pandemic, it just caused a lot of uncertainty about people rejoining the workforce, return to the office and inflation numbers and all that. But the economy is strong. I think the expectation should be we need a strong economy to justify asset prices. And obviously, when interest rates go up, people are going to reprice assets a little bit. So I just would expect that you're going to have a lot of volatility in the market this year. But you're going to probably have a pretty strong economy, which is maybe more important for most Americans.
Yeah, I'm glad you mentioned the macro story because you have an incredible...
So, you listen to that there. It's clear he felt like we were going to have a very, very strong 2022, obviously, right? There's no debate about that.
Point on the consumer, looking at your credit card statistics. I want to get into that. But we saw 199,000 jobs created in the month of December. That was about half of what people were expecting. The conversation is about inflation right now. The Federal Reserve expected to raise interest rates. How do you assess the economy playing out in 2022 and beyond, given all of that?
I think people are over-focusing on monthly numbers, which are distorted by a million different things, and that I think that the table is set for a very strong economy. That consumer has a lot of money and business has a lot of money. They're spending it. Confidence levels are going up. Jobs are plentiful. Wages are going up. It's pretty strong. This will be one of the strongest economies we've ever seen in 2021. And 2022 will probably be pretty good, too. And obviously, the fly in the ointment is inflation. And, no one knows exactly how it's going to turn out. I've always thought it wasn't just transitory, or at least people wouldn't feel it was transitory by the end of the year. And, some people think it's embedded in the market. It's going to go down to 2.3% by the end of the year. I think it'll be a little bit higher. But, look, if we're lucky, the Fed will engineer that so-called soft landing and raise rates, facing a strong economy and employment coming down. There's always a chance you have to do it faster than people think. And we just don't.
Never a good thing if you say, if we're lucky, this will happen, right? That's a little tough.
Exactly. No. No one knows the future. And if you look at anyone's forecast, they almost never get the inflection points right. So, but I also go back and you look at in March of 2020, we were on our way to 15% unemployment. It could have been 20% unemployment. COVID was killing a lot of people. You remember being in New York City, how terrible it was. and we didn't have a vaccine. So let's count our blessings still, and we're still getting through this thing, and hopefully Omicron may. We don't know about the future variants either, but hopefully Omicron may be the final one that makes this endemic.
He definitely brings a good point in there, talking about March of 2020 and unemployment rates were skyrocketing up and things like that. And I mean, we came out of that, so incredibly stronger than anybody ever anticipated in terms of the economy, in terms of stock market, in terms of real estate. Like, there was nobody, I mean, literally nobody that anticipated us to have that big of a comeback. And I keep track of everybody, and it was just amazing. And, wild things can happen in the economy, obviously, and things that you never thought would transpire could transpire. Years that you thought were going to be a great year end up being a bad year, right? Years you thought were going to be a bad year end up being a good year. And so things can change pretty darn quickly. And if we're noticing here, this interview from January, is very, very positive overall from Jamie Dimon.
There's certainly some expectation in that regard. But back in 2007, we were also looking at an uncertain market. You saw the crisis coming before many, and you started reducing areas with the most risk. Tell me about the risk around the Federal Reserve, going from an easing environment to a tightening environment. I mean, look, JPM and so many other financials benefited greatly from all of this liquidity. Do you see this as this liquidity about to go away? I mean, what happens now when the Fed raises rates and begins this balance sheet runoff?
It's interesting. You hear him talking about, reducing risk in 2007. And when you see him kind of starting to flip here, you got to start thinking, would JP Morgan start to make any moves reducing risk starting in the summertime or something like that, especially if Jamie Dimon gets more, let's call it negative on the markets, right?
Yeah. So it's very, very different in 07. In 07, the world was massively over-leveraged. Hedge funds, private equity, syndicated loans, some of the banks and investment banks, CIVs, banks globally. This is completely different. The world is not over-leveraged. You could say the government is, but the government has a whole set of different powers than the individual companies do, and consumers were over-leveraged back then. Today, now they're under-leveraged, so it's wholly different. So, I also think, look,
to be fair, I mean, pretty much all debt levels are higher than they've ever been at any point in the United States history. It doesn't matter just about whatever you want to look at as far as debt goes, consumer debt, real estate debt, like any debt, even margin debt, although that's been coming down quite a bit recently. Almost all of them are near all-time highs or at all-time highs, literally as we speak right now. So, yes, obviously everything's worth more, which is something to keep in mind. But, obviously worth can go down, right? Remember in the great financial crisis, there were homes here in Vegas that ended up dropping 50, 60+% in terms of what they were worth, 2 years, 3 years prior to that, right? So things could be worth, stocks, we see that all the time play out, where the stock will be valued at X amount of price, and then next thing you know, 3 months later, it's 50% down from that valuation. It's like, wow, 50% of that equity just got knocked out like that. It happens all the time. So that is something important to kind of keep in mind there.
You had pluses and minuses for everybody. I mean, keeping rates low is terrible for banks. The recovery was obviously very good for banks and all of that, and very good for everybody. So, there was $12 trillion of global liquidity, some of which can have to be removed. No one should be surprised the rate's going to go up, and that kind of monetary and fiscal stimulus, which is extraordinary, multiples of what the world's almost ever seen before. And it's going to be hard to figure out what it means when it gets removed. But in the meantime, jobs are plentiful, wages are going up, companies are healthy, consumers are healthy, and the market's going to be volatile because they're trying to figure out exactly what you're asking me. And you know what? They're not going to be able to figure it out. You just have to live through it.
I was reading somewhere.
He brings up a good point. Nobody can figure it out, and that's 100% true. No one can figure this out and how all this will play out. We can all like to have debates about this, and we think this is going to happen or this is going to happen. But the truth is, no one knows at the end of the day. We've never been through a scenario like this before in modern history, where you had a once in 100-year pandemic happen. You flood money out into the economy like never before, right? And not just the United States. I'm talking all the countries did this, right? And now you have massive inflation going on. You still have supply chains messed up. You obviously have a lot of things to kind of be concerned about out there. And right now we've had what has been considered a very, very strong economy. We're still trying to figure out how much of that was stimulus, how much of that was these insanely low interest rates that are unsustainable. So, you just have so many moving parts here, and that's what obviously makes it confusing. And that's how even somebody like a Jamie Dimon, for instance, who gets to see he's got access to probably more information on the financial side than the dang president of the United States, and probably by a lot, right? I mean, there's nobody out there that probably has more information, including even the Fed, in my opinion, into detail on what's going on in the economy and the banking system, in finance in general, than somebody like Jamie Dimon, right? And this is how even somebody like him can go from super, super positive to, in this next clip we're going to play, to all of a sudden talking about significant risks for the U.S. economy in a little over 3 month span. That's how it is.
That the stimulus was 25% of GDP. Jamie, how many rate hikes are you expecting?
I don't know. I rely on my economists. They're very, very smart, and they would probably say 3 or 4 this year. I would probably say a little bit more. Marie, I also want to put in perspective.
Interesting. He said 3 or 4. But then he said, he expects more, and now all of a sudden, I think the consensus on Wall Street's like at least 6, if not 7. We'll see what happens, and a lot of that comes down to are we talking about a 0.5% each time, or are we talking about 1/4% each time? That's very key.
Paul Volcker raised rates effectively 200 basis points on a Saturday. To raise it 25 basis points, if it goes up 1% this year, I don't think that in and of itself has an enormous economic effect. I think that all the borrowers that completely easy can handle that, particularly if you have a strong economy. So you can go to almost any company, higher sales is more important than slightly higher interest rates. And that's true for most things. And, housing.
I think, what it affects the most is real estate, right? 1%. You move up interest rate 1% on a mortgage rate, it matters. It matters a lot to folks and what they can afford or not afford, right? You talk about 2%, that matters even more. You talk about 4%, that's a massive number. And so if we think about what got us into a lot of trouble last time, in terms of the last massive financial crisis we really had in the United States of America, what really led us there was over leverage of debt and real estate. And so a lot of people look at it and they're like, debt's at all-time highs. And now all of a sudden, if interest rates continue to climb, that could kill off the real estate market. And could we be in another scenario that we get taken down because over-leveraged debt? And on top of that, you talk about real estate being in a place that could end up becoming very, very weak in the summertime and moving forward. And I think that's definitely a potential. That's obviously a concern.
We'd be slowed down just a little bit by that, but housing is booming. So, hopefully the Fed can navigate these things, but you're going to have to deal with higher rates. And people just get their heads wrapped around that. And by the way, they've been artificially low for years. Even just a normal would be 3.5% in the 10-year bond and 2% in Fed funds. Just a normal thing. And, that we're going to return to normality one day.
Yeah, that makes sense. Jamie, let's talk JPM for a moment. You had another great year last year. The investment bank on fire with all of the M&A, SPACs, all of the trading profits. But over the last year, we were questioning loan growth. It was not with...
Yeah, a lot of that business has slowed up, obviously. Where's the big IPOs and the SPACs this year? It ain't happening. And the reason being is there's just no appetite for those. A lot of those stocks, and I own a few of them, they can't even find bidders on them now that they've been public for a while. So there's no reason, if you are thinking about an IPO or a SPAC right now, there's no reason to even try. And that's why you don't see any of that happening right now. Next time we get into an excited market again, that things are booming, believe me, IPOs will be back and SPACs will be back, but that's just, we're not in that type of year right now. So most of these companies, they can't even consider. It's a horrible time. If you want an IPO right now or SPAC right now, one of the worst times I've seen probably since December of 2018 to even think about something like that. But actually, I would consider this a worse time than that even.
Many expected it to be. Go through the consumer and the commercial business, and how does loan growth look, and what do you expect for 2022?
Yeah, so I'm the opposite of it. I don't think loan growth by itself is a good thing. Loan growth is an outcome of decisions you make. But let me just separate the consumer from companies for a second. On the consumer side, there was plenty of loan growth in mortgages and a lot of payoffs in credit card. But that was because individuals were strong. Usually when loan growth goes down or negative, that's because people are over-leveraged. It's the opposite here. Loan growth was low because people had a lot of money and were able to pay off some of their, I think it was $150 billion of credit card debt. Et cetera. And then also a lot of the loan growth on the mortgage side was refinancing, which is actually better for customers. On the business side, it's completely based upon their needs. And their needs are based upon growth. And think of inventories, receivable, CapEx. And so as we return to normal growth, their needs are starting to go up. And so you're going to see banks reporting loan growth numbers and they're going to be better now than they were a quarter ago. But that's the outcome of a growing economy. And so you may very well, if I am right, you have good growth next year. Loan growth in the business side will probably return to normal. On the consumer side, it will return to normal. It just may take another 6 to 9 months.
Okay. All right, so that's his opinion there. So it's interesting, watching that and obviously seeing kind of an overwhelmingly bullish Jamie Dimon there, for sure. Okay, now we fast forward to now, right? And JP Morgan CEO Jamie Dimon warns of significant risk to the U.S. economy. All right, so that's definitely a pretty big flip. Let's call it that.
In the last half hour, Leslie Picker joins us right now with more on the numbers. Leslie, good morning.
Hey, good morning, Becky. That's right. JP Morgan shares were down a little bit more. Now they're down about 0.4%. Investors are clearly digesting the report this morning. As you mentioned earlier, they did beat on the top line, reporting $31.59 billion on a managed revenue basis. That was compared to estimates of $30.86 billion. Net income was down significantly for the quarter, down about 42%, driven primarily by this net credit reserve build of $902 million. Net income came in at about $8.3 billion for the quarter. One of the big question marks that investors had about JP Morgan and banks in particular this quarter was what their exposure to Russia was and how each bank fared during the quarter on that front. And with JP Morgan in particularly, this pops up within their markets and securities business within investment banking. They talked about how there was a significant exposure in commodities and markdowns of derivatives receivables from Russia-associated counterparties that resulted in about a 13-cent decrease in EPS. That we can
see. This is the thing with JP Morgan, and this is why I say Jamie Dimon has access to so much stuff. They're doing business all over the globe. I mean, when you start talking about they have deals in commodities and in Russia and all these sorts of things. I mean, this company is really doing business all over the globe, and they are really connected with everybody. And so, if you hear any sort of commentary about Jamie Dimon that he's warning of some risks out there, it's definitely something that should perk up your ears, considering it's a guy that's connected with everybody.
Let's read between the lines here and assume they're talking, at least in part, about that nickel exposure that we've talked about on this show related to a counterparty with one of the Chinese nickel producers that caught on the wrong side of the nickel squeeze during the quarter. Also, credit.
See, it's so funny, JP Morgan, you would think of that as like the bank on the corner, right? And maybe the bank that you guys bank with, right? You have checking accounts, saving accounts, and like if you think about investing in them, you're usually thinking about like that side of their business, right? And here they are, got this deal with nickel commodity, and it's just how diversified these businesses are and how many different places they're doing business. It can shake up their earnings, positive or negative, in a massive way.
Credit adjustments represented a loss of about $500 million, driven by funding spread widening, as well as credit valuation adjustments resulting from both increases in commodities exposures and those derivatives from Russia-associated counterparties. I know you gave some of the color from Dimon in the release, how he talked about how they remain optimistic, at least in the short term. And I think that short term is going to be something that people really dig into on the call later today with regard to consumer and business balance sheets as well as consumer spending. They believe at this point in time it remains at healthy levels, but they do see significant challenges. Jamie Dimon, CEO and chairman, on the geopolitical front and due to high inflation, supply chain issues, and the war in Ukraine. So still digging.
Yes, significant geopolitical and economic challenges due to high inflation, supply chain issues, and obviously
this release a bit more, but wanted to share those details, especially about what's going on with markets and securities and their commodity derivative exposure, guys.
Yeah, and I would say that focus on Jamie Dimon's comments is probably pretty important, too. Look, we always look to what Jamie has to say about the economy because he's got a very good sense of what's happening. More often than not over the years, he's been optimistic on things. So when you hear him talk about being optimistic in the short term, but looking and really acknowledging all of these bigger issues that are going to pose risks for the economy, that's significant. He is not somebody who gets his head turned easily by headlines in the newspapers, but he knows that these are some big issues. For him to highlight it, it actually matters. And this goes into this debate about what the Federal Reserve should be doing, how aggressively they should be raising rates to deal with the inflation picture, but how do you do that cautiously without sending the entire economy into recession?
That's right. It's his comments, and his comments, to your point, he's known for being candid, telling it like he sees it. If he thinks the economy is doing well, he's going to tell you. If he thinks that there are issues on the horizon, he's going to tell you that too. Right. So I'm guessing that will be a big topic of conversation on the call. And it's also about what they're doing. You've got a net credit reserve build of $902 million during the quarter. That compares with the release the prior year, which is why you saw such a big decrease in net income. So it's a combination of what his words say, what the color is that he provides about the state of the economy, and then also what they're doing about it.
Yes, 100%. So, it's interesting. Obviously, he's calling out inflation now, right? And it's interesting because if you saw the interview in January, he kind of a little blew that off, right? It was kind of like, I think it's going to come down, da, da, da. And now he's talking, about that's a significant risk to the overall economy. So I think there's definitely things to pay attention to, and just kind of keep an eye on and see what's going on out there. Obviously, there's a global economy, right? And that's much larger than the United States economy. So we see certain things that may be going on in the United States economy, but maybe are much worse in other markets. For instance, obviously in China, they got shutdowns now also going on. Europe's got a messy situation on their hands. The entire world's dealing with massive inflation right now. And to be quite honest, wages aren't keeping up with the massive inflation. And so it's just interesting kind of commentary. I'm going to listen to their entire conference call, which, by the way, I'm going to do it on the Hungry Bowl app where I can listen to it for free. But I'm going to listen to that, and I'm going to see kind of, any more color he could kind of provide on that. But there's definitely a flippening happening there in a very short amount of time. Now imagine next conference call, right? Is it gotten better, or is he even more cautious and less optimistic on the next conference call? We'll just have to see how obviously all that plays out, but it's definitely worth kind of keeping an eye on and paying attention to. Hope you guys enjoyed this video as always. Make sure you check out FTX, first link in the description down there. Use my referral code, HolySmokers, and get a free coin when you purchase your first $10 there. Much love and have a great day.